who you are and where you come from?
Well, I've been around a long time, but I'm guessing I'm not really all that famous, maybe popular in a very itty bitty niche corner of the real estate market. But for the last going on almost 18 years, I've been the co-host of the Real Estate Guys radio show. Before that, I was in the mortgage business and was in the mortgage business all the way up until the great financial crisis. I decided to get out of it because, as you may recall, the powers that be decided that the mortgage brokers were the ones that were responsible for the financial crisis, which I think was a blame well misplaced, but that's a whole different discussion. We got involved in training syndicators, people who want to raise private capital in the wake of the financial crisis in 2011. And we did that because we saw that the distribution chain, the pipeline of money from Wall Street to Main Street was broken, at least temporarily. And we thought there would be a big opportunity in private capital. And beyond that, as you well know, Anton, from my various rants at our seminars, I'm not a fan of Wall Street. I watched what Wall Street did in 1987 to my dad, who lost a 8-figure fortune that he had spent 10 years meticulously building, and he lost it in the October 1987 stock market crash. And partly because of his own ignorance, but that was because of a financial system that didn't provide any real financial education, and largely because of the shenanigans that go on in the casinos of Wall Street. That ended up 20 years later, wiping me out in 2008, like a lot of real estate investors that were only positioned for sunshine. And so that just, my animus towards Wall Street grew even further. And of course, in between, we went through the dot-com bust and the big real estate run-up. So I've had some good times. I've had some bad times. I think we're back on an upward roll, but we are, as you well know, sitting on the cusp of some real fragility in the financial system. Fed raising interest rates substantially after a 40-year basic bond market bull market since Volcker hiked rates. And now we've got Jerome Powell, head of the Fed, coming out going, hey, we're going to raise rates as high as it takes to crush inflation. And I think a lot of people listening out have no idea what that really means, if they in fact follow through on that, and what that could mean. So depending on where you want to take this, we have a lot of things we can talk about today.
Yes, definitely. Thanks for that background, Russell. It's quite amazing, right? Since all that money has been pumped into the market. Obviously, we have seen record levels of the indexes. And as soon as there was this announcement, oh, now we have a problem, right, with inflation, and we have a balance sheet at the Fed level that has been exploding, we need to dial it back. What happens to the stock market? It immediately reacts, and not in a positive fashion, right? So at some point, I think it's a clear message. Things cannot just go up and up and up. And once you remove some of that liquidity and easy money, it has an immediate negative impact.
Well, I think that people who are out there trying to make sense of what's going on in the markets really have to take a step back. And instead of looking at charts and graphs and listening to different prognosticators, I think if you step back and try to understand the basic mechanics of the way the market works, and a lot of us as consumers, if you will, or Main Street people, are trained and really, I think, distracted by focusing on the stock market. But where I really pay attention is the bond market. The bond market is way bigger than the stock market. It's where all the big money play, the international money, the sovereign money, the government money is and emanates from. And it really forms the backbone of the financial system, the banking system, and all of the credit markets. And so the health of the bond market, in a lot of ways, is the health of the financial system. The financial system supports the flow or the distribution of currency. In this case, the dollar is the world's reserve currency, having replaced gold after 1971 as kind of the world's reserve currency, even though the dollar officially took that role in Bretton Woods back in 1945. But gold still backed the dollar, at least internationally, until Nixon took us off the gold standard in 1971. A lot of people don't even pay attention to gold, but central banks do. And people who understand what's going on in currency markets are paying attention to gold. But you have the financial system, you have the currency that flows through the financial system, which is for most Americans only the dollar. And I think I would encourage people to think outside the dollar. And then you have the economy. And the economy is really just the mechanism of producers and consumers getting together in the open marketplace and exchanging value. And the way you earn the right to consume, ostensibly, is by producing, and then you exchange your produce for somebody else's produce. When you start printing money out of thin air, you're essentially counterfeiting production, and people who did not produce are able to consume. And when that happens, you get this ugly thing called inflation. And the powers that be, the Federal Reserve, the banking system, and the governments have ways to kind of hide or shelter the market from a lot of their profligate printing. But at some point, it gets out. The Fed has taken their balance sheet, as you mentioned, from 800 billion prior to the great financial crisis to 4.5 trillion coming out, and now double that. I think it's approaching 9 trillion or something like that right now. And if you look at the dollars, the currency that we carry around in our wallets, it says Federal Reserve note. It's an IOU. And so as the Fed's balance sheet grows, what it's effectively doing is printing gobs and gobs and gobs of money. Some of that money is locked in the bowels of the financial system and doesn't see the light of day. But as it works its way into the system, primarily through government spending, and we've had a ton of that, it then begins to affect pricing. I did a presentation on last year's annual investor summit where I talked about stagflation, how stagflation works, what causes it. It's a phenomenon a lot of people haven't seen unless they were around and aware in the 70s. I happen to be just old enough to have that recollection, Anton. I think you probably do too. And that was a very different environment. When you understand how inflation can cause stagflation, and that's the environment we're in, and how this inflation that began to kind of peek its nose out of the water, if you will. I give the analogy like a whale breaking the surface. It either just kind of just floats up to the top and blows off a little steam and then kind of goes back down, or it's got a whole lot of momentum and it's going to come flying out of the water, like these big whales that jump and make this big splash. I speculated back in June of last year that this was not transitory, that this inflation, in fact, had a lot of momentum. And we can talk about why I think that. And then it popped out of the water. And I think now the genie's out of the bottle. The Fed has a big inflation problem. They can't control it. The administration has a big inflation problem. It's not just the United States, it's global. And it's working its way to Main Street, and voters, of course, are very, very upset about it. So it portends a lot of change politically, probably in policy making, both at the monetary level with the central banks, and also at the fiscal level with the governments in their spending, and ultimately at the consumer level, where people are literally going to be changing where they live based on tax, based on cost of living. These migration patterns, bringing it back down to real estate, the business you and I are both in, is going to affect. Some markets are going to be losers. Some markets are going to be winners. I happen to be in Arizona, in Phoenix, Arizona. It happens to be one of the winners. California, one of the losers. People come from California, come to Phoenix. You have downward pressure in California, and you have upward pressure and supply and demand issues in a place like Phoenix. And this is happening in various markets, Florida, other markets, Texas, markets like this. So there's opportunity in all of this chaos. And I think that when you understand the way the financial system works, and you can begin to get an idea what the policymakers are likely to do and how that translates to Main Street behavior, you as a Main Street real estate investor can then begin to make strategic moves, both in your portfolio and also in terms of the markets and the demographics and the product niches you cater towards, to take advantage of what's going on. There's going to be winners, there's going to be losers.
Mm-hmm. Absolutely. Right. Now, we have seen what that liquidity does to the, as we call them, the traded markets, right? Like stocks and bonds. They react much quicker, right? Because the money can be immediately deployed and it has an immediate impact. When it comes to real estate, usually it takes a little bit longer until all that liquidity is reflected in prices. And we certainly have seen that over the last 2 years with record housing prices, but also we know it on the multifamily side, right? So a lot of people believe it's strictly driven by the undersupply of housing. I think we need to be realistic there. There is yes, there are certainly pockets where there is an undersupply. You mentioned Phoenix, you mentioned Texas, where a lot of people are moving. Is there enough housing there? In a lot of markets, there is not. However, I think we also have to be realistic and recognize it's also all that cash that has been put into people's hands that they can pay more for homes, as well as investors that have to deploy all that money. And ultimately, when you have interest rates that are being dropped to close to zero, where do you have to invest? You have to invest in investments that have higher returns, and naturally, real estate is one of the logical conclusions there, which then puts a further upward pressure on real estate.
Well, you've got a couple of things going on in any market, any commodity, whatever it is. Price action is not just a function of inflation. It's not just a function of leverage. It's not just a function of supply and demand. It is a combination of all three. And so a lot of times people don't understand the difference. Just because price is rising doesn't mean you have inflation. You just could have greater demand exceeding supply. Sometimes that supply is a temporary limitation. As everybody knows, we had COVID and the lockdowns and supply chain disruptions. I think that's a lot of the reason why the Fed and other people were claiming that it would be transitory. Hey, these supply chain disruptions will work themselves out. And then at that point, production will come back up and it'll catch up to all this extra money that we printed. It'll meet the supply, or it'll meet the demand, and things will moderate. However, you can't just flip production on and off like that. And so that was, I think, just naivete on the part of the people who are academics who have never actually run a business and have no idea what it really takes to open a factory, to create a production line, to make things happen. So that's one issue. The second issue is leverage. When people are able to readily access credit and bring money from the future, which is all leverage is, you take out loan and you borrow money from the future that you are going to pay back later to purchase today. Student loans is an example of that. As soon as you subsidize student loan or education with student loans, you end up not making it more affordable. You make it more expensive because you brought all that purchasing power from the future into the present. This is why real estate, or any commodity or asset class that's heavily dependent upon leverage, is very sensitive to interest rates. And so people are thinking, hey, real estate is going to slow down because you've got this increase in interest rates. Well, that's true for the people and the product niches that are dependent upon debt. But I think, to your point, you've got a bunch of people out there sitting all kinds of capital, and they don't need leverage. They need a safe place to put money that's real, and they're getting very nervous in the stock market. And so you look at big funds like Blackstone that is deploying tens of billions, maybe hundreds of billions of dollars into real estate. They're not using leverage. They don't care about leverage. They're just looking for a place to put capital where it will be safe and be hedged against inflation. Money that normally would have gone into the bond market for safety has to go someplace else. And real estate, in particular, multifamily real estate, affordable residential real estate, is one of the very, very safe havens in the real asset class that institutional money seeks. And so you've got some real upward purchasing pressure as capital is pouring into that sector. And that has nothing to do with interest rates. And they don't really need the high yields because they're not looking for cash on cash returns. They're looking for where that money's going to be 5, 10, 20 years down the road. And of course, if leverage comes back, if employment really and real wages actually were to go up, then that's all going to be bullish for their bet. But if not, they've still found a safer place to put their capital than bonds. So there's a lot of dynamics going on in the market. And again, I go back to my early comment. When you're a fledgling real estate investor, there are 1,000 million things you can study. And there are a lot of purveyors of financial education that are going to try to convince you that you need to study all of these things. 90% of the things that people are tempted to pay for to learn, their technical advisors, their professionals can provide that. What I think an investor really needs to focus on is understanding the mechanics of the system, the context of the market, the geography, the demographics, and the product niche that they're investing in, and how what's going on at the macro level affects the micro level, so they can make good business decisions. Let all that technical stuff be handled by your lawyer, by your accountant, by your property managers, by your mortgage brokers. Let those people handle those technical deals, and focus your education on your understanding the financial context of the investment decisions you need to make as a business person, as a wise investor.
Mm-hmm. So obviously we have had the best run ever when it comes to real estate investing with interest rates lower than what we ever can remember, with mortgage rates on the single family side being in the twos, even for 30-year loans into the low threes. Same thing has happened on the multifamily side, where you were able to get long-term borrowing in the upper 2% and low 3%. Obviously, that has changed now quite dramatically, very quickly. With the Fed signaling we have a problem. We need to raise the Fed rate, and with the market also recognizing that we have an inflation problem, which brings then the 10-year treasury and the whole yield curve up to a much higher level, which has obviously immediate impact on borrowing cost. Just to put it in context, as you know, Russell, the 10-year treasury was in the around 50 basis points during the height, if you want to call it that way, of COVID-19 in 2020. And even last December, we were at roughly 1.4%, 1.5%. Now we are somewhere around 2.8. We have even gone above 3% for a brief period. So essentially doubled the 10-year treasury yield. So that's a 1.5% increase over just 6-month period, which has a massive impact, obviously, on the residential mortgages, but also on the commercial mortgages. And at the same time, because the Fed has raised their Fed rate, and there's expectation that they will continue to raise over the next year or so, we have a significant increase on the short-term borrowing too. So what do you suggest a real estate investor should do? We already know that the stock market is impacted negatively, and we have seen it over the last month, that the stock market is already stuttering quite a bit. Real estate, I think, will probably also go through an adjustment period due to the higher interest rate. So what do you suggest real estate investors to do in that environment where we know the long-term borrowing costs have gone up, short-term borrowing costs likely will go up even further?
Well, I mean, I think there's a couple of things. One is, as I've talked about, make sure you see the big picture. I could spend some time going into the bigger dynamics of what happens when the 10-year yield goes up. It increases government borrowing costs, which could potentially mean more printing of dollars. You know, it's like when you run your credit card up too far and you got to borrow to continue to pay. And then all of a sudden debt compounds and it's a death spiral. I'm not saying that could happen to the United States because they have the printing press, but it means printing and more inflation. So there's that. It also means that bond values that are already out there, and there's trillions of them, begin to fall. And if those bonds are margined in the financial system, just like a stock margin, when the value of the underlying stock, when you have margin stocks, falls, you get a margin call. That creates a liquidity crisis. The same thing's true in the bond market, but the bond market's much, much larger. And so we could have some liquidity issues out there, not just in the bond market, but in the derivative market, which is in the hundreds of trillions of dollars. And so that lends itself towards some real financial instability. So you look at the risk to the dollar, the Fed needing to print a lot of it to try to save the financial system, the risk to the financial system that the credit markets could in fact collapse. And that's kind of the backdrop. So now you look at just making your everyday decisions. I'm underwriting a property. Can I count on interest rates going down in the future when I'm underwriting a property today? Is it realistic for me to think that lower interest rates will be there? No, I don't think you can count on that. Do I think that the Fed is going to have to back up and interest rates will come back down? I think they might try, but the market may say, hey, I don't care, because in order to do that, you're creating inflation and I'm not going to buy these bonds. I'm insisting on a higher yield. I mean, if I buy a 5% bond and inflation is 7%, I'm guaranteed a -2. I might demand 7. And so the Fed doesn't have complete control over the interest rates. They're the biggest player. They can set a target rate. They can step in and manipulate the market. But at the end of the day, the market is going to dictate what those prices are. So you can't count on that. The other thing is you got to realize that if inflation is going to be persistent, it's going to affect your tenant base. You can't just waltz in there thinking you're going to be able to push rents simply just based on prosperity in the economy, high unemployment or high employment. You can say, well, we've got very high employment. Yeah. And wages are going up. Yeah. But real wages are not, right? Inflation is eating into wages faster than wages are going up. So effective purchasing power for your tenants is going down. So I would be very cautious about underwriting a scenario where you think you're going to be able to get lower interest rates in the near term, or you're going to be able to push rents in the near term unless you have a really, really strong supply and demand dynamic going for you. So underwrite conservatively. That's what I'm saying. Now, you may say, well, gee, if I do that, then gosh, I'm not going to get any deals because everybody's overbidding. Well, then you may want to finance conservatively, either bring in more down payment or use the down payment that you might have used and purchase high yielding debt. So in other words, say you're only going to get a 4 cap or, on a property, but you can take what would have been down payment to make the cash flow more conservative. And instead of investing it at the 4 cap or the note rate of 4%, you go buy an 8 or 9% yielding investment. You're going to have better cash flow in that blended portfolio and your equity outside of the property. So you can use some creative strategies to augment a conservative cash flow model that don't necessarily mean putting more down payment in. And so I think consider that. The other thing is I would maintain more liquidity in my reserves. I'd be prepared to weather a downturn. I would take really, really good care of my tenants. Don't take them for granted. If you've got good tenants, take good care of them. Turnover and vacancy are huge expenses. I think that's real estate investing 101. And in a bull market, you can say, hey, I'm anxious for this tenant to move out because we want to get a new tenant in. I can push the rents. I don't know that I would be thinking I could play that game. Obviously, if you can purchase something out there that still has some value add left in it, and you can, get equity and be in a good position based on the buy, push the rents based on the value, that's the best place to go. I don't need to tell you the space is extremely crowded because everybody's trying to play that game. But, if you're out there hustling and you have good connections, you can certainly do it. So, the other thing is I would consider looking into locking in longer term financing. You might say, well, gee, why would I want to do that when interest rates are high? What if they come back down? Yes, that's true. And you have to deal with things like prepayment penalties, defeasance, and all that if you decide you want to refinance earlier. But I'd rather have the security in case, the market interest rates really get out of shape, to know that I've got 10 years instead of just 5. Or if you can get even longer than that, that's great. Sometimes you can do the math and decide, hey, interest rates came way down. I'll go ahead and pay that defeasance and just redo the loan anyway, because it makes financial sense. I always say, do the math and the math will tell you what to do. But I do think that you have to sharpen your pencil. You need to be better advised. You need to see the bigger picture, and you need to play a longer game if you're going to be a real estate investor, especially if you're using debt in today's market.
Yeah. So I think to summarize of what you said is become more conservative, right? Yes, there are opportunities out there, but do not count on the easy money, and that you can refinance still with easy money flowing in 2 or 3 years from now, right? And we already see that with a number of deals that are struggling to get into a refinance scenario because they're having, obviously, because of the higher borrowing cost. And I would say we also have seen it already on the buying side, where some buyers recognize that they need to be a little bit more conservative. There's still plenty of buyers out there that are willing to take the risk. But I think listening to you, I would say what is important for our listeners to understand, just because someone else is willing to be highly aggressive doesn't necessarily mean that you should be. And one of the key elements really is, if it's your own money, you do whatever you want, right? But if you are syndicating a deal, you bring in other people's money, sit down with these investors and explain to them, look, yes, we can go with a higher leverage. Yes, we can go with a short-term bridge loan that is a high leverage, but we may be better off just to accept a little bit of a lower return and be safe. And once we have a 5 to 7, 10-year time horizon, we already know based on history that having that piece of real estate as an investment is still a very good investment compared to most of the other investments alternatives that are out there.
Yeah, well, I mean, you know how I feel about that. I think that you, as a syndicator, you have got to take a look at the big picture, and then create an investment thesis, a strategy that you believe in based on what you think are the probable outcomes and the various outcomes. Nobody knows what the future is. It could break 2 or 3 different ways. I think you have a preferred plan, a conservative plan. If things go your way, you can move into a more aggressive posture. If things don't go your way, then you're in a good position. One other thing that I would really strongly recommend, and I've done in my own life, is build a big network of high net worth people that are going to be the beneficiaries of inflation. That are going to have strong balance sheets and liquidity and have capital they're going to want to deploy if the system does break temporarily. If we have another 2008 and you have relationships with people that have capital and you can bring deal flow to them and put those deals together while capital credit markets are broken, where there's blood in the streets, as they say, as Warren Buffett has famously said, be greedy when people are fearful and be fearful when people are greedy. I think that if you can explain that to people and they follow your leadership, and you have a portfolio strategy, you have an investing strategy, and you have multiple exit strategies or hold strategies. And part of that is having a big network of high net worth people that can step in and help the group collectively dollar cost average. In other words, if you overpay for a property today in hindsight, and then all of a sudden 2 years from now, there's an implosion and there's bargains, well, then the pendulum could swing the other way. And if you're able to move into that market and pick up those quality assets for pennies on the dollar, and then you put that into a blended portfolio, you've mitigated a lot of the damage from the overpayment. And then, the investors have partaken in that also. And of course, the other way is to say, well, I'm not going to invest in this market. I'm going to wait for the crash, but the crash may never happen. Or the crash may happen in terms of purchasing power, but it may not happen in terms of dollars. You can have a numbers being up, the prices, the asset value, everything being up, and yet the economy is very slow. That's called stagflation. And this is a phenomenon a lot of people don't understand. You can have a recession, you can have a slow economy, you can have a weak economy, you can have weak real earnings and real purchasing power, and yet numbers are all up. And that is a very difficult environment to invest in, especially if you've never seen it. And most of the people out there investing, most of the people managing money, most of the people advising advisors right now have never lived through this, right? Unless you're in your 60s or 70s, you weren't even a grown-up when this happened the last time it happened. And so it's wise to study it. We're going to be talking about this a lot on our investor summit next month in Belize. Going to bring some big brains. We're going to be talking about that. And of course, we talk about this a lot in our syndication mentoring club because it's a very, very different environment. And I think that's one of the other things. Not only have a network of people who have high net worth that you are in touch with, that are you're talking with about what's going on, but have a great advisory board. Listen to shows like this, attend conferences, listen to what the thought leaders are saying, let them help you get the talking points and the interpretations of what's going on to form your understanding of the macro picture and your investment thesis, so you can go back and then pivot off of these more credible people than you to make your point, so that your investors are like, hey, I heard that person on TV, or I read that article or that book, or I heard that podcast or video interview, and that person really makes sense. And when you come to them and go, hey, this is my investment diagnosis and prescription, and they're like, hey, that sounds just like this notable person that I heard, that makes sense to me. And now you've got both good ideas and access to capital and more credibility as you're getting in a position to take advantage of whatever the market gives you, or to mitigate whatever losses may be coming your way. As you mentioned earlier, Anton, I think it's an important point. The big benefit we have in real estate is real estate does move slowly. So when things start to downturn, it reacts more slowly. You have time to adjust if you're paying attention. When things start to pick up, it adjusts more slowly. So you have time to get in and go for a ride. Your job is to determine where are we at in the cycle. right? Is the system starting to fall apart? And is it time to start maybe getting ready for a storm? Or are we on the front end of the next bubble with all this printing and inflation? I can't tell you the answer. That's why I go to these conferences and have these conversations with these people. I'm still forming my opinions, but you want to have yourself positioned so that it doesn't matter to you whichever way it breaks. You've got a plan, you've got a team, you've got an investment thesis, and you're ready to go and to take advantage of come what may.
Yeah, very good points. You mentioned one thing, right? Look at it from a portfolio perspective. Right. When we talk about stock investing in particular, dollar averaging is tossed around all the time. I think what you are suggesting here is really doing the same thing with real estate. Yes, even if one believes that there is a cool down, that there is potentially a crash, timing a crash is extremely difficult, right? So on the real estate side, I would say the perfect example is Ivy Selman has already rang the warning bells in 2004, 2005, and it took another 2 years, right? So ultimately, she was right? Now, I think there is the same situation today. I think we can all kind of agree that we certainly are in a bubbly territory today when it comes to real estate, but how it ultimately will turn out is very difficult for anyone to predict, particularly because I have never been in that environment with the trillions that have been deployed, with the Fed's balance sheet at the level that we have never seen. So we are really in a new environment, and no one really can tell you what's truly going to happen, right? We can only assess, and we have to make decisions with our investments based on that. So I think that dollar averaging is a smart strategy, right? Have enough dry powder that once you have that situation that you can take advantage of lower prices. At the same time, invest and just make sure that you do not lose the keys during that possible downturn, whenever that downturn comes.
Right. Well, I'm obviously agree. I think a lot of real estate investors, and I've spent 20 years working with real estate investors, tend to think in terms of transactions. They don't think in terms of portfolio. And so even as I mentioned earlier, structuring a buy where you're using some debt in the portfolio, high yield debt to offset weak cash flow in a property, that's a portfolio strategy. That's two assets working together to create a result. A portfolio could be a handful of assets. So that's really important. The other thing that I think people need to prepare for that's unique for this generation of investors is history says that world reserve currencies have their season in the sun and then they fade into the sunset. I don't think the dollar is going to be any different. Now, does that mean the dollar is going to lose reserve currency status tomorrow, next month, next year, this decade? I don't know. But I would say the signs are there that it could happen. There are major forces that are trying to de-dollarize the world right now. And I think some of what we see going on geopolitically is designed to try to protect the dollar's dominance. And so if you as an investor do not have a plan or even an understanding of what the world would look like if the dollar lost its world reserve currency, and certainly what your world would look like if the dollar lost its world reserve currency, that's something I would put on my discovery list. I would start to really think about that and begin to understand that and to organize my portfolio around that. The other thing is to really understand the fragility of the financial system. You know, there's a lot of banks out there that have a lot of derivative exposure. When interest rates first started to rise, these banking stocks all tanked. And the reason I think they tanked, and some of the analysis that I read, I'm not a stock guy, I'm not a stock analyst, was because of their derivative exposure. And derivatives are the thing that blew up in 2008 that nobody really understood. I didn't understand them. I think a lot of people today understand them much better, but that doesn't change the fact that they're out there. And that just because you understand the problem doesn't mean the problem doesn't exist. It just means you understand the problem. For some of you, you don't even understand the problem. So note to self, understand the problem. Number two is you got to develop some form of a strategy to mitigate that problem if in fact it manifests. If the banking system were to collapse, even temporarily, if the credit markets were to collapse, even temporarily, if the currency were to lose its reserve currency, do you personally have a plan for that? If you don't, now's a good time to start thinking about how to organize your portfolio and how to organize your education, your network, and your investing strategies and teams to have a plan for that. And then watch for the signs. Hopefully, you'll see them early in time to take a corrective action, whatever that may be, because it will create both opportunities and challenges depending on who's aware and prepared. Your mission, of course, is to stay both aware and prepared at all times for a variety of outcomes. To your point, Anton, nobody knows how it's going to break. And I mean break, in terms of which direction it's going to go, or it could collapse in terms of breaking, like everything just breaking. Nobody knows. Just got to be prepared.
Yes, you mentioned derivatives, right? This is actually one of my key concerns, right? I entered the banking world, as you know, initially in investment banking. I was a young man when LTCM happened in the 90s, and that was all driven by derivatives, right? And these were some of the smartest people in the world when it came to math geniuses. They misjudged the market movements, and obviously that created that black swan event. So we just don't know when it happens. Inflation is in everyone's face. That's not a black swan event. Ukraine invasion is not really a black swan event. Why it was really is a black swan event is what we do not know what is going to hit us virtually overnight and unexpectedly. And so only all the derivatives exposure in the marketplace, that is, I would say, is likely going to be, again, what is driving a significant collapse if a collapse is coming, right? One of my concerns really is also on the financing side, right? As you know, we had LIBOR as a borrowing rate, and LIBOR had a lot of its issues because it could be manipulated. It was manipulated because there were just a few major banks that were able to set that rate and manipulate it accordingly. But it was unsecured, right? So it was not driven by a security. Now they replaced it with SOFR, which stands for Secured Overnight Financing Right. So again, secured, which is really having treasury bonds and so-called repo them and borrow against them, right? So technically, yes, it's secured. The problem is now it's an open market rate, which if that repo market breaks for whatever reason, now that rate shoots up dramatically. And we already have seen it once in the fall of 2019 when the repo rate jumped up by 5%, right? It was a brief period, but it still happened. So, and it was all driven by some institutions having overexposure in a derivative market that they didn't expect. And because we are now in the tied to the SOFRs only on short-term lending, that is only a concern. And we just do not know whether that potentially can be that black swan event down the road, right? So it's really important, as you mentioned, right? Be aware of what is happening out there and protect yourself. Don't just stay in cash because you're scared, right? Because cash ultimately, as we now experience it on a daily basis, your purchasing power will evaporate. You need to invest, just invest that you are protected from any of these potential black swan events that could happen.
Well, I think one of the big risks that a lot of people don't understand in the financial system, especially people who are not in real assets, like real estate and precious metals and energy and things like that, is counterparty risk. The system is rife with counterparty risk. When your asset is simultaneously somebody else's liability, basically an IOU, if you have $500,000 in the bank, you don't have the $500,000, the bank does. What you have is an IOU from the bank. And if the bank fails, you have a $250,000 insurance policy with the FDIC, but the other $250,000, not so much. And you say, well, yeah, but the government or the Fed would bail out the banking system. Maybe. But in order to do that at a catastrophic level of failure, they would have to print dollars to do that. When you get those dollars back, to your point, what are they worth? They may not be worth that much. So you can think about being liquid and you can think about cash two different ways. Liquidity can come in the form of other assets, commodities like precious metals, or other things that are convertible into a variety of different currencies or other commodities if you needed them, or are exchangeable in their own right. And so, that's one thing to think about. The other thing is when you're holding cash, probably not a bad idea to have a chunk of cash, and I'm not talking millions of dollars, but a chunk of cash outside the banking system. If you look what happens when a banking system gets shut down, even temporarily, like what happened back in Cyprus a few years ago, where all of a sudden you couldn't go to the ATM and get any money. And when you could only get maybe a $200 or $300. You were limited on how much money you could get, and you're trying to pay your bills. Now, the thing is, when cash is scarce like that, even though there's plenty of it, but you're locked out from getting to it because the banking system has been shut down temporarily for that moment in time. If you have cash and people need cash, then there are bargains. And so again, this is just the idea of being prepared for a variety of different outcomes. And I'm not saying the end of the world. I think humans will rise. We will figure it out. A new system will emerge. Maybe the powers that be will replace the failing system we have today with some form of a new system. The Federal Reserve has been tossing around this idea of a central bank digital currency, and that's been going on all around the world. Some are already doing it. Certain sovereign nations, El Salvador, for example, and others have adopted Bitcoin as a currency that they'll use. We don't know how crypto and the emergence of blockchain technology in the currency space is going to evolve at a sovereign level, at a national level. We don't know. But that's something else to be paying attention to. These are really, really uncharted waters. I can tell you, when you talk about black swan events, back in 2019, I noticed this big explosion in cash, the Fed pumping cash into the repo market. I wasn't even quite sure back then what the repo market was, but I picked up the phone, called my buddy Chris Martinson, and said, "Hey, Chris, I see all this money going into the repo market. Do you know what's going on?" He says, "No, I'm watching it too, but where there's smoke, there's fire." A little while later, I discovered this guy named George Gammon, who we've become friends with, came on our last year's investor summit, coming again this year. And he has done a better job than anybody I've ever met in terms of explaining to me what the repo market is, how it works, and what what the symptoms of damage in the financial system are and how they manifest in the repo market. It's very, very, very important thing. So if you're not a follower of George Gammon, his whiteboard videos, go check him out at georgegammon.com. I think you'll be impressed. But in January of 2020, just a few months later, I was on the phone with Chris again. And Chris said, "Hey, have you heard about this COVID-19 thing?" And I said, "No, never heard of it." He goes, "Well, you better pay attention to it because it's about to change the world." See, just that little bit of heads up, just that little bit of heads up. And that's the power of being connected to people who are way up on the flagpole or way up on the crow's nest, looking out at the horizon, seeing things you don't see. Who in the world would have thought we would shut down the entire global economy, that we would put people literally out of business, impose what have turned out to be unconstitutional eviction and foreclosure moratoriums, and all of the damage that happened as a result of COVID-19, completely unforeseen by almost everybody, but Dr. Chris Martinson saw it coming. And so when you're connected and you're listening to the right people, all of a sudden you realize that non-financial events can quickly become financial events. It immediately had an impact on credit markets, the stock market, the Fed's activity. Interest rates were dropped immediately. trillions of dollars was printed and injected into the economy. And the consequences of that now we are now experiencing. At the time it was happening, other people watching how the reaction to COVID-19 was being rolled out were predicting, Peter Schiff among them, like, hey guys, this is going to lead to inflation. It won't be transitory. They've injected too much money. They've disrupted supply chains. There's going to be shortages, right? This shouldn't shock anybody, but it all had its roots in COVID-19, which nobody saw coming. And yet Chris Martenson gave me a heads up in January of 2020. And we did a whole series on our YouTube channel about crisis investing. We convened a panel of the smartest people we knew as soon as that broke to hear what they had to say. And that's the advantage of being in the position I'm in as a co-host of the Real Estate Guys radio show. I have access to these people. Of course, when you listen to our show, listen to Anton's show, pay attention to people like Chris Martenson, Peter Schiff, George Gammon, you start to see all these things too. It's a great, great investment of your time. For people that have hung with us out this long, I applaud you. I know it's kind of wonky talk and maybe not exactly quite as exciting as where the next best deal is or how to negotiate an extra $1 million down on your next property purchase or whatever. But from a practical standpoint, I think your financial education and learning how to navigate these uncharted waters will end up being a really, really good investment of your time and effort.
Yes, absolutely. Right. So this is really, you mentioned being connected. I would say that that's really what the real estate guys are, right? You're connectors. You're connecting people with other people that have knowledge, that have different views, that give you insight, right? You may agree or disagree. It doesn't matter, right? The fact is that if you just operate and live in your little bubble, you may think that you know the right things, but the reality is very often you do not, right? And that, I would say, that's one of the greatest values of you and Robert and the real estate guys, that you're really connecting, that you bring different views to the table. And why don't you tell us a little bit about the real estate guys, and obviously also how to reach out to you? I know that I'm looking forward to the summit in Belize. It's already sold out. So anyone who is listening, sorry guys, it's too late, but maybe you need to sign up for next year. But we got
a 100-person waiting list. But it's going to be a ton of fun. So yeah, so we've been broadcasting since 1997 on terrestrial radio. We still do that. We started podcasting around 2009, around that time. In the wake of the 2008 financial crisis, I kind of took over as the business manager of the show, and we divested ourselves of some other business interests and really focused on the real estate guys. And we decided that we needed to hang around with really smart people. We need to ask them really hard questions, and we need to listen carefully to what they say, even if we didn't understand it, and to stay in the game until we did. And then we found out that we could create environments where we put them together, and we could share all of that with our audience. So we do that with our YouTube channel. We do that with our radio show and podcast. We do that with our annual investor summit. And we also participate in another annual conference every year in New Orleans over faculty, but there's also a whole lot of people he meets on ours that he doesn't know. And he gains insight into the way we look at the world as real estate investors. And of course, he's a precious metal and mining and resource guy. And so we get a lot of insight into the economy and the currency and the financial system and gold and its role and energy through him. So we like both of those events. Our primary emphasis in coaching or training people, our motto is education for effective action, is syndication. We teach people how to raise money. There's a lot of real estate people out there that are hustlers. They get out there in the street, they find deals. Most of them, when you get good at that, find more deals than they have credit or capital. And that's what syndication really solves. It's the ability to go raise money from investors who have more money than time or expertise. They don't want to be invested in Wall Street. They're looking for a hands-off investment, but they want to be on Main Street. That's the opportunity for syndicators. We've had people raise tens, 20s, 50s, hundreds, and two guys that have each gone over $500 million raised that have come through our program over the last 10 years. So we're super proud of that, continuing to do that. We do the Secrets of Successful Syndication seminar twice a year. We just did it in March. We're going to do it again in September. People who are interested in doing that can send an email to syndication@realestateguysradio.com and get all the details. We're going to have Donald Trump's former real estate attorney, 4-decade attorney, George Ross, come out and be our guest speaker at the next one in September. So we've had him once before. He was a big hit. Can't get him every time. But about 5 years ago, we got him, and he's getting up there. He's in his mid-90s now, but he's coming out. He's going to share his wisdom. He's seen more deals than most of us will ever see. Really smart and funny man, brilliant guy to hang out with. Work and get to know people as human beings, not just virtually. I think that's really, really important to do. And then consider starting a club of your own. Consider getting an investment group together right in your own hometown. Get together with other people, do book studies, listen to podcasts, talk about the things that you've learned, what's going on. Sharpen your brain with a little mastermind group. We did that for a number of years. In fact, I'm getting ready to start one up again here in the Phoenix area where I live. And for anybody that's interested in tips on how to do that, we wrote a white paper on this many years ago, but I think it's very, very valid today. You can get that on for free just by sending an email to club@realestateguysradio.com, club@realestateguysradio.com, and get a little white paper on how to form your own investment club. I think that doing that could be one of the smartest things you end up doing at a time like this, and it can lead into all kinds of other opportunities when you get together with like-minded people. Hopefully, we'll see you at a Real Estate Guys event here real soon. Otherwise, we'll see you on the radio, realestateguysradio.com.
Yes, thanks, Russell. Please, guys, if you haven't gone to the Real Secrets of Syndication, is really a great event. Obviously, listening to their podcast is a great educational experience. Again, it's not just real estate. It's only a lot of it is real estate focused, but it's much broader. Just sign up and listen to them, right, and to the guests that are there. It's very valuable. So, Russell, really appreciate you coming on, sharing your wisdom, and obviously looking forward to see you in Belize and meeting with all the great speakers there. Some of them you have mentioned will be there, so I'm looking forward to connect with them there. And thanks again for coming on.
Well, thank you for having me. Really appreciate it. It's been a lot of fun.
Yeah, same here. Thanks.